and welcome to IMI Insights Podcast, where we discuss emerging ideas and trends in businesses with our faculty. Managing our money well is something that we all struggle with. And it's not just always about the maths or the numbers, it's about the right mindset and cultivating the right habits. Especially today, when we have new opportunities, new digital tools, and also a changing economy, budgeting and saving is not the only concern that we have when talking about personal finance. To break down what it really is and understand more about how to go about doing proper personal finance, we are joined by Professor Harshita, who is an assistant professor of finance and accounting at IMI. Welcome to the podcast.
Thank you, Farhana, for having me here.
So, reading your article has been very fascinating. There's so many points that you touch upon. But before we even get into all of that, please tell us why financial literacy is not just a luxury, but everyone from any sort of strata of society should be able to understand it and know it well.
Talking about financial literacy and why is it important for everybody, it's not something that has emerged in terms of importance. It had always been important. And if you ask about my own journey as a student, I wish I would have been taught financial literacy maybe in the school days so that I would have known it better. The reason why it has become even more important in today's times is because of the changing landscape or the changing dynamics. One, there is a lot of change the world has become much more uncertain than it was earlier. If you remember our parents' times or the generation of our parents or maybe elder than that, there was less uncertainty there. One, they used to have, so once they joined a job, they used to tend to stick to it. So they had less incentive to switch jobs. And even the companies had less incentives, or their companies were not very prone to laying off and all those things. These days, laying off has become very common. That is one aspect, which is the uncertainty. The other thing that you talk about is people have now become much more ambitious. So earlier, if let's say you are in level 0, the maximum that you would have dreamt of is to go to level 1 or level 2. Now the people are talking about taking leaps. So instead of going to level 1 or 2, they want to jump from, let's say, level 0 to level 5. And you can't do it without financial literacy. So it's something that is there for everybody, and it's something which has become essential.
So, when we think of personal finance and how to do it well, we always think of investing. But in your article, you're very clear that building an emergency fund is more important. So why is that something that we should consider even before investing?
And the reason why good point that you have brought in, the reason that I have specifically mentioned is that it comes before investing, or investing is not one thing that one should start with is. Typically, this is the mindset for people. Once they start earning or maybe start getting pocket money, start dealing with money, one thing that they have in mind is one of the ways to grow money is investing. So investing is something that comes as a quick go-to thing for everybody who has money that in hand to play with. But it is very important for us to understand that investing is not or should not be the first step to start the journey. Emergency fund is something that one should build first. Emergency fund is a fund that it's like a cushion that you can fall back on if your active source of income is not working well. Let's say you are switching jobs and you have a period when you are not earning actively. Emergency fund is there to take care of you. The reason why again it is important is one, if somebody is very aspirational about it, wants to switch jobs, you have to have something that you can fall back on. So emergency fund is one that comes in place. Two, if there is a sudden expense that comes in your way and your current income is not enough to sustain that expense or to take the burden of that expense, emergency fund is something that helps you again sail through that patch. And emergency fund, it's a rule of thumb. It's not something that fits everybody, but as a rule of thumb, emergency fund, you should have at least 3 to 6 months of your monthly expenses as your savings. So 3 to 6 months, if you are very, let's say, a risk lover and you want to take more risk, probably even 6 months savings are not enough. Maybe you have 12 months of savings for that matter. So depending upon how risk taker you are, how risk lover you are, and how financially stable your current level is, probably would decide how many months of savings you have to have as an emergency fund.
So this is just plain old saving. It's just nothing to do with investing or any other things.
So when we say emergency fund, one, it should be very liquid. So we don't say emergency fund should be invested in something that is illiquid. So it should be one tap away probably. Talking about about these days, digital apps and everything, it should be one tap away. But we don't suggest that you put all the money in savings account. Even when you talk about savings account, we have a lot of features available. One of the common features, which again is not known by everybody, is every bank's savings account comes up with a feature which is it's called an auto sweep or a sweep in account,
Okay.
wherein you have the flexibility of a savings account, but the interest that it earns is much more than your savings account. So you can maybe give a standing instruction to your bank that, I mean, there is a threshold beyond which you can apply that. So any money that flows into your savings account above a threshold would go to your auto sweep in,
Right.
start earning interest higher than your savings interest. Or you can yourself do it through internet banking or something, that you manually transfer your funds from your savings to your sweep in account. So that is one thing that we should, I mean, it's not always, I mean, not complete savings, but savings plus something.
Some
But it
kind
has
of
to be,
interest that you
yes,
could
but it
get.
has to be it has to be liquid, it has to be
Easily
yeah,
accessible.
and it should not be into risky avenue. So it should be a
Right.
safe place for your emergency funds.
So another thing that you highlight is, of course, insurance, whether it's life or health. So how does one go about choosing the right insurance for themselves, and how does it sort of impact in this whole personal finance scenario?
The second step that we say, once you have built your emergency fund, or maybe side by side while you are building an emergency fund, but before you jump onto investing, is to insure yourself. And when we say insurance, we talk about both the things, medical insurance as well as life insurance. Medical insurance, whenever we buy a medical insurance, we have to be very, very careful about the clauses that are associated. So there are a lot of medical, I mean, not medical, but a lot of clauses that are associated with any plan or any insurance that we buy. So we have to be very careful about reading between the lines or understanding the
Yeah.
clauses. Some of the examples, if I may quote, is for example, there is a clause which is said to be an exclusion clause, which says even if you have an insurance cover, these things are excluded from your cover. So you should know what are the things
Which
that are
exactly.
excluded. Then we talk about something which is, let's say, co-payment, which says even if you have bought an insurance cover, every final bill that comes, it would be co-paid by you. So let's say there is an 80-20 co-payment, which means 20% of the bill would be
Has to
on
be,
your pockets. So these are some things as I mean, when you're buying a medical insurance, you should be careful about. Term insurance, again, a very important thing is when we talk about life insurance, we primarily would be referring to term plan. Term plan is a cover which provides you a lump sum coverage once the person who has bought that plan deceases. So I mean, passes away.
Right.
So it's something that your heirs would be getting. That is term plan. One mistake, which is a very common mistake that people do while buying this insurances, and probably all of our parents would have done it. So, I mean, if you recall, I have got those LIC policies which my parents
Right.
bought from me,
Yes.
and that continues. They are called endowment plans. They are a big no because those plans give very less in terms of the interest that they provide. And two, the coverage is too small for
Okay.
it to be called as a life insurance. And three, primarily it's a way for the middlemen to make money. So most of the premiums that we pay on those endowment plans, they go to the pocket of the middlemen who would have sold those policies to you. So that is one thing. So endowment plans should be a big no. Any instrument which mixes your coverage of insurance with any kind of investment, or as let's say a payback, is something again which is a big no. So when we are buying life insurance, we should always stick to buying a term plan.
Okay, and not to go into endowment plans and all of
Not
that.
at all. So ULIPs, endowments, or I mean,
Yeah.
those payback things, they are something which should not be gone to. And these days, the reason digital apps have made it more easy is because you have one platform where you can make a comparison across all the offerings for all the
Yes.
companies. And two, you also have facilities wherein you can approach experts who can give you a customized or a personalized plan that
yeah.
suits you. Because even if, let's say, we are both of same age, my requirement in terms of the coverage that I require for my term plan could be very different from yours. And the same goes for medical insurance as well. So same age, probably my lifestyle is very different from yours. My health condition is very different from yours. My financial liability is very different from yours. So taking all of these things into account, insurance is something which has to be a very customized thing. And there are a lot of apps which facilitate doing this customization or providing, and they also help you with buying these policies. So this is what digital apps have made life a little
Yeah,
easier for
easier
us.
to understand.
Absolutely.
So now you've built your emergency fund and you've done the insurance. So finally, we come to investing.
Right.
So when you're looking at investing, especially for first time investors, what are some of the things they should keep in mind, or how do they go about it?
Investing, few things that we should understand is one, investing should not be done in one particular asset class. So when we talk about investing, one thing that we should keep in mind is that our investments should be very well diversified.
Right.
And when we say diversified, it should be diversified across asset classes. So I don't say if you're buying stocks, you buy stock of company A and company B and it is a good diversification enough. It should be diversified across asset classes. Again, a rule of thumb which says is 100 minus your age is something that you should invest in equity. So equity is something which is an asset class which provides you a higher return, but then also is more risky, because any investment, we say risk and return go hand in hand. So equity provides you that jump in your expected returns, helps you beat inflation. So there are a lot of pros that comes with equity, but there is huge risk that is involved in equity. So 100 minus your age. So let's say you're 30 or I am 40. So if you're 30, probably 70% of your investments should be in equity. If I'm 40, 60% of my investments should be in equity. Rest remaining of it could be into other asset classes, let's say debt. And when we say debt, it could be any fixed income security that provides you an assured return. It could be in real estate. It could be in gold or any other asset class. But real estate and gold, again, we have to be very specific how much do we put. And it should be, it's always suggested they are kept towards the lower end of your total investment portfolio that you have.
So, when we talk about investing, of course, I think being smart about it is the right way to go. You have to be very, you have to plan it well. But nowadays we have so much access to, market knowledge, and even investing has become really easy. Like you said, it's one tap away on your phone. So how do people sort of balance this risk taking and like a financially prudent way of doing it?
For everything that we say, if you're not good at doing something, you should, one, either try to be good yourself at doing something, or you can maybe outsource it. For example, if you become sick, first we try to do a home aid or something. We try to do it yourself, and if it goes beyond our ability to do it, it's always suggested you better go to visit a doctor. Something similar to that. So investments also the same way. If you feel you want to do it, keep everything in your hand, taking decisions as to where to invest, when to invest, it's suggested that you be good at it first. So if you feel you are good at it, only then you should keep everything in your hand. Otherwise, there are a lot of ways to outsource investment. When we say outsourcing, what I am typically referring to is, let's say, taking the mutual fund route or taking an ETF route. Mutual fund is, there is an expert who is designing those portfolios for you, and you buy a portion of that portfolio. So that way you get the expertise. It of course comes with a cost, but then you are saved from the hassle of learning to do it. And investing, again, it's better not to be overconfident and be over optimistic. You have to be realistic in your expectations. That is one. And these days we talk about a lot of alternative investments. That is, crypto is one very common example. So crypto has seen huge rise in the past, but it has also witnessed an equal fall. So for all those risky avenues where the returns are very promising, but equally is the risk, one should be very, very disciplined in terms of ensuring that you only put your pin money in those investments. Pin money is something that even if you lose the whole of it, you should be fine with it.
It shouldn't bother your budgeting or saving and all
that. So it should only be beyond what you are. Everything that is, let's say you have a dream to buy a car, that dream should not be, tried to be achieved by putting money in a crypto. So you have to put only the pin money. Even if you lose the whole of it, you should be fine with it. It should not, impact it. Definitely would impact you financially, but it should not be bothering to impact you. So that is what we should keep ourselves limited to risk taking.
So, of course, a lot of, everything is on our phone nowadays. Everything is easily accessible. We also have a lot of instant loan plans, EMIs that we get. So debt planning would you say is equally important? And in this kind of situation where everything is so easy for us, like getting a loan or getting an EMI plan is very easy. Absolutely. So how does debt planning then, how can one do a debt planning then?
Yet another very important step when we talk about the entire journey of personal finance or financial planning
Yes.
is debt management. Debt management, as we all understand, trying to manage the money that you ask from somebody, which you have to eventually repay.
Mhm.
It has become very, very important for us to know the skill of debt management well, is because now getting debt has become very, very easy.
Yes.
So many of the times it is one tap away. We have a lot of companies selling products, expensive products, and they say you get it at an easy EMI.
Mhm.
So and EMI is basically what they do is they make expensive things look affordable. So you
But you're
get
paying an interest at the end
yes.
of the
So
day.
that is something that is you realize later, but it appears very affordable. So
Yes.
very expensive, but let's say it's a very small EMI, and you feel it's fine. It's not going to hurt my pocket. So one, companies have this tendency to push those offers. Then we have these schemes which is buy now pay later. So you consume it now, you pay it later.
Yes.
Again, makes things look that they are very affordable. So these things make it more important for us as consumers to be disciplined and strict with our investments, with our choices. So debt management, one thing that is said is, the only way to manage your debt well is not to manage it well as to what you have on your plate, but have less on your plate that is easy
So
to manage.
avoid being like sort of enticed by all these plans and
Absolutely, that
instant
is more
loans that you might
important.
get.
So
Right.
debt management is, it's not only about, so if I have 10 loans, how do I manage? It's about how do I make sure that I do not have those 8 unnecessary loans,
Mhm.
and I'm only managing the 2 ones. So that is something, there are ways that we can have. So for example, when you talk about those notifications that push us or attract us to do those expenses, maybe we can take calls to put off or turn off those
Yes.
notifications. So that is one thing. Or you have to be very, very disciplined about ensuring that you do not get allured into all these
Right.
things.
So another thing that you mentioned is of course tax planning, and for most of us, we would pay, do our taxes even much later. Initially, when you start working, this is not something that is a big concern for you. But you mentioned that it's actually important to start
Absolutely.
as soon as you start working. So why is that?
Tax planning, you can see it is a way, not only, so tax is a portion of your income that you have to give to the government.
Yeah.
But in a way, tax planning can be seen as a route to ensure that you do savings and investments more properly. So it's a forced discipline that you put on yourself, because when we say tax planning, there are a lot of investment avenues that help you reduce your taxes. So if you start investing in those schemes, if you
Mhm.
start saving money that way, it is in your interest. One, there is less outflow of tax, and two, it is also helping you build the corpus, that investment corpus. So, if you postpone it, one, if you're, let's say, do it till the end. So, we're talking about people who are employees. A part of your tax is taken care of by your employer,
Yeah.
because they do not even hand it over to you. So, every pay slip that you get, there is a
There's a
TDS,
tax,
that
deduction.
tax that your employer takes. But beyond it, if there is any money or any source of income that you are getting, and you wait till the last moment to do all those plannings, one, you have less time to take decisions taken in hurry may not always be in the best interest of you. And two, if you postpone everything till the end, or if you keep procrastinating for everything to be done at the end, it's a huge financial burden on your pocket as well.
Mhm.
So it's always a good idea that once the financial year begins, once you start earning, you start planning for your taxes. And another very important aspect when we talk about tax planning is that in India specifically, that choice between new regime versus
Yes.
old regime. And again, there are a lot of apps which help you take those decisions. So it's always advised that you take a call which of the two did, and this is something that you should revisit every year, because every year
Mhm.
the choices may be very different depending upon which of the two help you save more.
Right.
So tax planning, as I said, as you also already said, it's very important that way to start.
So another thing that you mentioned, I'm sure a lot of us, especially somebody who's just in their mid careers, have not thought about it at all, is retirement planning. And you mentioned how important it is to actually start it early as well. So how does one go about doing this retirement planning, and what are things that we should keep in mind when we start with this?
Retirement, if you talk about, you're absolutely said. If you talk about a young person and ask them to imagine them retired, it's something which is, very difficult, or maybe beyond their imaginative capacity to assume that they have retired. But these days, we also talk about this tendency for people or this rush for people to retire early. So a lot of those young people, they have this desire that they want to retire early. So they want, and when we say early retirement, they are primarily looking for a phase of life when they do not have to actively work, or they can follow their passions. So they can work at their choices, not going to let's say a 9 to 5 job, doing something that they have to do for money. So you have your financials well taken care of, so that whatever time is left, you plan to how do you spend those times. Doesn't mean that those time has necessarily to be financial, rewarding that way, but it is at your own choices. So you don't work at other people's choices. But important things that we need to keep in mind is when you talk about financial retirement planning, one, if you plan to retire early, it's very important for us to be very conservative in terms of expecting what your life expectancy would be. So you have to be very, very calculative that way. So let's say we are talking about somebody living for 90 years of age and planning to retire 45, then we are talking about 45 years of life where they have to sustain with funds that they have accumulated just till 45 years of age. So the sooner you plan to retire, the longer you have to sustain yourself for the post-retirement phase. So it's important that you have those expectations right. You do not say that 45 I retire and I have to sustain myself for next 15 years. That is too unrealistic in today's time. We have a lot of medical advancement, everything. Second mistake that people do is inflation is something that they fail to account for, which is going to take away a lot of their savings a very big way. So you have to be realistic that way as well. So you have to take inflation into account when you are calculating how much funds you require for an early retirement or for retiring that way. Third that we talk about is when we are investing money for taking care of those retirement ages, we have to be realistic about those returns that we get on our investments. So let's say somebody says that I have had enough investments. Those investments are going to take care of me while I retire. And then they say that I expect that those investments are going to give me a return of, let's say, 16% or 18%. Now, it's an unrealistic expectation. You cannot expect your investments to keep giving you returns of, or a consistent return of 16 to 18%. So these are things which you have to be very realistic about when you're planning for your retirement.
So another thing that you mentioned is, I personally haven't really given it much thought, and I'm sure it's not something that people think about when they do personal financial planning, is estate planning as well. So what does that really mean, and what are the factors that people should keep in mind while doing that?
Estate planning, a very important aspect of personal finance. Very well said. It's not very, thought of by a lot of people. There is a very, I would not say popular, but there is a quote that says, where there is a will, we all know this quote, where there is a will, there is a way. And a follow-up line to this is which says that where there is no will, there is a way for the middlemen to make money. Okay. So if people pass away without leaving behind a will, there are a lot of legal processes that their heirs have to follow, which involves a lot of middlemen, and there's a lot of way they can exploit this situation of the life of the heirs and make a lot of money for themselves. So, people say that it's one of the biggest disservices that you do to your kins if you go away, or if somebody goes away without leaving a will behind, because it's a mess of assets and liabilities that you leave behind without an instruction or a set of instruction as to how to deal about it. There is huge funds which are lying with banks which are unclaimed, which insurance companies which are unclaimed. So a lot of people's savings, investments are lying unclaimed only because people are not aware that there was somebody in their family who would have maybe purchased, done those investments or purchased those plans. So estate planning is very, very relevant. You should, one way to do it is you write a will. Writing a will is something that anybody can do even on a piece of paper, but there are certain basic things that you need to follow. For example, the will should be dated, so there should be some witnesses who are there to sign your will. The will should be updated. So you keep updating. You put in all your assets and liabilities there. And you at least inform somebody in the family or some confidant who you confide in that they are aware that there is a will that is existing. It's as simple as that. And there are processes where you can register your will that makes it even more enforceable legally. But if you have those will in place, whatever you leave behind, it's easier for people who inherit all those things, for them to mess. So it reduces a lot of
chaos and sort of.
absolutely. And for middlemen to make money, it's a very good way for them if you leave things behind without giving without writing a will.
without
So
a
very,
will.
very relevant that way.
Right.
And again we have those platforms. So we have online platforms which help us write a will. So this is something which has again become easier, I would say, in today's digital world.
Yeah, that's interesting because nobody really thinks about it unless you reach a certain age and you're like, okay, now maybe I should start working on it. So before we wrap this up, you've clearly mentioned that, apart from all the knowledge that we may have about finances, what is really important is the habits that we inculcate. So what do you think are some of the habits that make us sort of bad planners, or what are those habits that we should actually inculcate to have good financial planning?
For anything, even when you talk about, let's say, healthy food habits, a lot of us know a lot of things about eating proper, doing regular exercises, and a lot of those things. But many of us tend to not, or end up not doing it. So knowledge, as they say, is not even half the battle, even in terms of financial planning. So even when we know a lot about this is what we should do and this is what it should be done, a lot of us end up not following these. So, and this is the toughest part of financial planning, I would say, because it is not something that can be taught in the classroom. It's more about developing these habits day in, day out, over time. So few mistakes that people do when they are doing financial planning is, one is those spending that we do very impulsively. So so today salary gets credited in my account, and I have this impulse of starting to do a lot of shopping and expensing. So that is one thing that we need to keep in check. The other thing is, we have a tendency to follow what the herd is doing. So just because my colleague has bought a new car, I also have this tendency to buying a new car. I see everybody around me owning a house or buying a new house. I should not give in just because everybody else is doing it. They have their own finance. So everybody has their own financial journey. And I should be calculative about if that thing is, what is relevant for my colleague probably might not be a relevant thing for me. It might not be relevant at this stage of my life. So I have to be very prudent about deciding what are the things that I put my money in. The other thing is, we already talked about these things. There are a lot of apps which are incentivizing us to spend. Credit cards, for example. So one of the biggest thing, credit cards. I remember my PhD thesis supervisor. She always mentioned the only way that you can manage your credit card is to not have one, because credit cards, they allure you. They say you spend more. And you get cash back. Just like paying an interest every month. And they say you spend more, you get cash back, you get rewarded. So that actually induces us to spend more. So you have to be very selective about what are things that you are owning, which help you be more disciplined. And even if you, let's say, do mistakes once, twice, thrice, if you keep practicing, eventually it's the practice that eventually will make a difference. So you don't have to give up. That is one thing. And you have to keep practicing to be more and more disciplined. And build better habits like you do with anything. Absolutely. Yeah. So thank you so much, Professor Harshita. This has been very interesting and very enlightening. We've learned a lot about personal finance and how to manage it. Thank you so much. Thank you, Farhana.